I'm excited to share with you some research, as you said, entitled National Wage Setting. This is joint work with my colleague Joe, Heather Sarsons, who used to be at Booth with me and is now at UBC, and Bledi Tosca at Burning Glass Technologies. So if you have any questions as I go, please feel free to interrupt. I know we have some questions at the end, if any clarifying questions. Want to make sure you're along for the ride with me. Okay, so we know that the US economy has kind of been increasingly dominated by large firms that are operating in many markets. So we can see the importance of large firms by some research, previous research, kind of talking about the important role that superstar firms play in the economy. And some work by some of my colleagues in the economics department, Esteban Rossi-Hamburgs and Cheng Tai-Sheh, have shown that big firms, they don't just grow by getting bigger in their kind of current footprint, they grow by really expanding into new markets. So the Cheesecake Factory doesn't grow because each Cheesecake Factory gets bigger. Instead, it expands and it opens up new locations in lots of different markets. And so we think, therefore, understanding how these big firms set wages across space is going to be really important for understanding what this kind of rise of big firms means for the US labor market. So in this paper, we're going to kind of take the first step in this direction. And we work on documenting basically how firms think about setting wages across space and a little bit on why they choose to set wages in that way. So just to fix ideas, benchmark models that you may kind of have learned about would basically suggest, on kind of basic economic intuition, I think would suggest that firms should vary their nominal wages across space for potentially a variety of reasons. They may do so because workers are kind of differentially productive in different areas. They may do so because the local cost of living is quite different, say in Chicago or San Francisco. And there might be kind of differences in local competition. It may be really easy to find a software engineer in San Francisco and really hard to find one in, say, Omaha if you need to hire one there. And so all of this would suggest that firms would kind of set different wages for the same job across their locations. We're going to find in this paper that, instead, it looks like a large minority of firms, not all firms, but a significant chunk, do something we call set wages nationally. And what this means is that they adopt kind of geographically non-differentiated pay structures. So the same job being in multiple locations gets exactly the same nominal wage. And this may seem surprising, given what I just kind of set up as kind of the basic economic theory. It's related to some patterns we've seen in the context of unions or in Europe. And it's also related to some complementary patterns that have been documented in the literature for prices. So there's been literature showing that firms set the same price for a carton of milk across all of their locations. And this is saying they kind of do so on their other big price that they set, which is the wage. Okay, so why didn't we know this before? Well, it's challenging to measure this moment, national wage setting, with most of the standard economics data sets. So why is this? A couple of reasons. The first is that most data sets report earnings, not wages. And so if you work different hours per day or per week, or a different number of weeks per year, right, you're going to get differences in pay, but the wage is actually the same. And second, job composition varies a lot across space. So CVS, say they have their headquarters somewhere and they have, branches of CVS other places, they're going to have a lot more cashiers in, say, Houston than wherever they have their headquarters. And so if you don't observe the job that the person's doing, i.e. you don't observe like their occupation, their job title, you might think people are paid very different amounts, but that's just because they're doing different things. Where you have been able to compare people doing the same thing, you would have understood that they were getting paid the same. So in this paper, what we're going to do, most of our evidence is going to come from posted job level wages from a data provider called Burning Glass Technologies. This is going to be, think about a job posting. They post a wage at the job. That's what we're going to be looking at. We're going to have data from online vacancies from 2010 to 2019. And we're going to see the posted wage for a firm and then where the job is located. We're going to think of that location as the county and the detailed occupation. So what the job posting, the job title on the posting is about. We're also going to supplement this with a survey that we ran for HR professionals where we asked them, do you actually set wages nationally, and if so, why? And we'll have some administrative earnings data, which suffers from this issue, but accounts for maybe some other issues that are in the job posting vacancies, and I'll show you that as well.
What share of jobs post their wages?
Around 5% of postings have posted wages. So a handful, not a ton of them, and that's going to be where these kind of two other data sets come in. More so now, this isn't in the paper, but if you're kind of thinking about your own research and using data like this, more firms do now. There have been a bunch of states that have passed pay transparency laws, so like New York State's a big one. You have to post the wage with your vacancy in several states. Okay, so in case we don't get to the end or you kind of, your attention dwindles, let me just make sure you take the punchline home from the beginning. So the first, as I already previewed, we find a large amount of wage compressions within firms across space. So wages vary little within the firm. They vary substantially less with local economic conditions within the firm than between firms. And this is kind of most starkly exemplified by the finding that within a firm, about 40 to 50% of posted wages for a given job are actually identical across locations. We argue that this within-firm wage compression is really a choice. It reflects national wage setting on the part of the firm. It's not just that these firms are operating in all the areas that kind of just look similar to each other. We give some evidence on why firms seem to be doing this. Firms report actually setting wages nationally for a lot of reasons. The two big ones are some part of it's managerial simplicity. It's kind of hard to figure out what to do for different wages in different locations. And the other seems to be a kind of notion of fairness, which is that it's these kind of nominal wage comparisons that are really important to workers when they're kind of searching across jobs and things. It's the nominal pay as opposed to the real pay, i.e. kind of like your pay adjusted for cost of living, that seems to be really salient to workers. And so that seems to be kind of what constrains firms. And then lastly, we kind of speculate on some of the broader consequences. It kind of affects the amount of kind of wage adjustment in response to shocks and can kind of have effects on income inequality. Okay, so with that, let me jump right into the meat of the paper. So I want to start with just a simple conceptual framework. Maybe you've seen this in some of your classes, something like this, just to sort of fix ideas for how we think about firms setting wages across space. So it's going to be a combination of just kind of two simple models, just to name them in case you're familiar with them. One is just the standard model of wage setting within firms with kind of firm market power. That's the Card, Cardoso, Heine, and Klein model. And we're just going to combine that with a very standard model of spatial equilibrium. How do you think about kind of choosing where you want to live, sort of thing. We're going to think each firm I is operating an establishment in each region. And households here technically they have idiosyncratic nested logit preferences. What does that mean? That means they first choose a region to live in, and then they choose the firm that they want to work at within that region. And so what the upshot of this is going to mean that the firm faces an upward sloping labor supply curve, right? That sort of makes sense. What does this say? This says the amount of labor that's supplied to that firm is an increasing function of the wage. You pay more, you get more workers. The elasticity of the labor supply with respect to the wage is given by this row here, which could potentially vary by region, right? So what's the elasticity? When you increase the wage by 5%, what kind of percentage increase in your labor supply do you get? And then this here is a bunch of other things that are basically shifters of the labor supply to that region that are independent of the firm's decision. So something like how expensive it is to live in San Francisco, right? That's going to be one of these shifters, the price of things in San Francisco, because it affects all firms within San Francisco equally. And people are choosing the location, and then they're choosing the firm. Okay, so what are firms doing? So that's kind of how workers are thinking about it. What are firms doing? Well, they are choosing their wage to maximize their profits in each establishment. That's what we usually think of firms as doing. How are we thinking of them producing here? They have some productivity A. That could vary by firm, by region, right? Your Starbucks could be much more productive in Chicago than somewhere else, or depending on whatever is in the soil. You get to sell your output at some price. That could be a national price. Probably it's a local price. And you get to produce with labor according to some function. And you maximize your profits. What are your profits? It's what you can produce and sell, your revenue, minus what you have to pay. And here you just have to pay your wage bill. So what is this going to lead to? This is kind of a standard equation you might see in labor economics classes. We often get an expression for the wage, which is a function of two terms. right? Your wage is some markdown of your nominal marginal revenue product. If the market's perfectly competitive, this markdown, there's no markdown, and you're just setting the wage equal to the marginal product of the worker, right? If you have some labor market power, means if you raise your wage by a little bit, you don't lose all your, or you lower your wage by a little bit, you don't lose all your workers, you just lose some of them, right? Then you have the power to set a markdown. And so this is kind of a standard kind of optimization on the part of the firm. And so what's the upshot of this little detour here? Well, it's that you might expect wages to differ across locations for lots of reasons, basically two broad ones. One, maybe there's different marginal revenue products, right? Maybe lawyers are just as productive in Houston, but they only bill at Houston rates, right? And New York lawyers bill at New York rates, right? So their marginal product would be quite different. And maybe there are differences in markdowns across locations. That's that competitive force, right? Maybe software engineers are much more competitive with each other in areas where there's lots of software engineers. There's a high elasticity in that market. You know that if your firm lowers your wage, you're not going to take it because you can find another job pretty easily. And so there's a bunch of research that suggests all of these things actually vary across space. And so we might expect wages to vary across space. So what we're going to do now is we're going to go into the data. We're going to look at the geographic distribution of wages within the firm. And we're going to argue that it's very hard to reconcile that with this standard model of wage setting. Okay, so let me talk about what we do. So a bit on the data here. So as I previewed, our main data set we're going to use is the data of posted wages on vacancies from Burning Glass Technologies. So what's Burning Glass Technologies? They're a company that scrape online job boards and then clean them up. They scrape from 40,000 online job boards. Our sample, once we clean everything, so about 5% post wages, once we clean everything up, and you have to have a firm and location and everything, we're going to have 1.2% of all vacancies. And those vacancies are going to contain the firm, the occupation, and the county. So this is a job for a CVS cashier in Chicago. Okay, so benefit is it overcomes some of the shortcomings I said before, right? It's wages, not earnings. So if these people are working more hours or not, we're not going to confound this. And we see different establishments within the same firm, and we see exactly the job that you're doing. The limitation is that these are posted and not realized wages, right? So if you ex post bargain with your employer to get paid something else, that's not going to show up in this. And so we're going to supplement this with two other data sources. First, we ran a survey with a large HR organization. So the economists have a professional organization called the AEAs, the Association of Economists. This is basically the AEAs, but for HR professionals. We sent the survey to 3,000 respondents and had a 13% response rate. These are mostly HR managers and executives who are directly involved in setting pay in their firms. Most of them were at pretty big firms, so firms with more than 500 employees. And we designed the survey to ask, how do you think about setting wages across space? And if you do set wages nationally, why would you choose to do that? And so I'll show you some of that. And then lastly, we have some administrative earnings data. We're going to have quarterly earnings for all workers in the US who are covered by unemployment insurance. Why is this? Right, this is a data set that when firms that cover you with unemployment insurance every quarter have to submit to the state a record of everything you earned in that quarter, because that determines your eligibility for unemployment insurance benefits. And so that's who's going to be in this data set. We're going to have 26 states. And in that, we're going to observe your firm, so your CVS, what CVS you're working at, and what you earned at CVS in the quarter. And then we observe a little bit about you. The problem is we don't observe your wage. We observe your quarterly earnings. And we don't know what you do. They don't report that to the state. So we're going to merge this with a big survey that the census data runs, the American Community Survey, for 1% of the population each year. They collect a lot of, and maybe some of you have been in it, they collect a bunch of information about households. And importantly, they collect the number of hours you're working so we can get a wage. And they collect your occupation. You tell them what you do, and they code it up into an occupation. So from this, we're going to kind of approximate something like, for 1% of the population, we're going to have your wages and occupations. Okay, so let's start. I'm going to organize the patterns that we see into 4 descriptive facts. the first one is going to be that as I've said before, a large share of wages are set identically within the firm across locations. So to do this, we're going to look in our job vacancy data, and we're going to look at all pairs of jobs across space. So we're going to construct within firm pairs. So what we're going to do is we're going to look at some firm A. They're hiring an accountant. They're hiring one vacancy in New York County. And they have one vacancy in like Suffolk County, Massachusetts. That would be Boston. And we're going to take the difference in the wage between the posting in firm A for an accountant in New York and in Boston. We're then going to have kind of a loose comparison to a between firm pair, which is take that same job posting at firm A. So think of this as like, Deloitte hiring an accountant in New York County. But instead of comparing it to Deloitte's posting for an accountant in Boston, we're going to compare it to like, PricewaterhouseCoopers posting for an accountant in Suffolk County, Boston. And that's going to give us kind of our between firm comparison. It's kind of what's the, what might we have expected the difference to be between Boston and New York. So before here, I'm going to show you this between firm distribution. Yeah?
Yeah, I have a question about just like the job posting side of it.
Yeah,
Because
sure.
I've seen with job postings sometimes that they do like a general form. So for
Oh.
example, for like a cashier at CVS, they might just do sort of a general form with the same salary and then have like multiple different locations, like copy paste it.
Yeah.
Does Burning Glass like account for that, or is that something you've considered?
Yeah, so if it's one posting, and what they've done is they said, here's the wage, and they have multiple locations in the same posting. Okay, that's true national wage setting. If you've posted your wage and you said you get this no matter where you work, right? We're actually not including that. We're only taking separate postings. However, maybe we should have included that, right? Because if you're posting, so maybe you guys know, a very known national wage setter is McKinsey, right? McKinsey pays exactly the same wage, starting salary, to their, and so they might post, and they post wages because they operate in states where they have to post wages. So I think when we were working on this in like 2019 or something, McKinsey was paying $80,000 for an entering business analyst at all of their locations. And so that's the kind of thing, we'd be including here. Yeah.
Because like one concern I might have is that what if the employer, like once again, it's like posted versus actual. What if they're like promising a wage in general, but then when you apply for the job, it's a location-specific wage?
Yeah, so that's possible. We don't think that that's what's happening for a couple of reasons. First of all, these wages actually line up pretty well with realized wages. So if you look at the distribution of wages in this data set across locations and you compare them to the realized distribution of wages across locations, they look kind of similar. That's not to say there's not ex post bargaining happening. But I think, second of all, it's a weird recruiting model, right? If you're going to ultimately be paying people more, so you're not going to post, say, I'm going to pay you $50,000 and then I'm going to pay you less, right? That would really piss people off. But, so now you've said $50,000 and you're actually going to be paying people in San Francisco more. Like, you should, people are going to be looking at your ad and saying, oh, that's not enough for me to live in San Francisco. So there's certainly some going on. But from the best guess and from what we've talked to HR professionals, that's rare that you would kind of systematically bump up for San Francisco and not put that on your posting. You might bump up for like, oh, you have a master's degree. I'm actually going to bump you up above the posting. But that's more kind of like, and it could be that people with master's degree congregate in San Francisco. But it's rare that you would have kind of a default location-based adjustment and not put it in your posting, just because you want to recruit people to say, hey, come work at my firm. Okay, so here's the between firm differences. You can see here they're somewhat dispersed. The median is 30%, and around 9% of these between firm pairs have the same wage. This contrasts with the within firm pairs, where the distribution is very much shifted to the left. And this is kind of within firm wage compression is highlighted by the fact that around 50% of these within firm wage pairs are actually at 0. So what are some examples? Yeah?
What would it look like if you looked between firms but within the same city?
So we did this at the level of the county. So a lot of cities are like mostly, like think of Chicago, it's kind of like mostly Cook County. Yeah, I don't know. But the data is not, you're thinking like, does the CVS in Lincoln Park and the CVS in Hyde Park sort of like pay the same? Is that kind of what you have in mind?
I was thinking back to the previous slide. Yeah, that one. So that's between firms, but it's also, there's variation in firm and location. What if there's just variation in firm but within the same county? What would that graph look like?
Oh, so how different is the wage dispersion within firms? So like, I'm looking within New York, are Deloitte and McKinsey and whatever, are they all paying the same, or are they paying different? Yeah, so that's a little bit, so I don't have that here. That's a little bit of a different question. There's certainly wage dispersion across firms within the band. Yeah.
What's the distribution of these posted wages? Is it just the cashiers, is the managers and the higher, is it beyond the entry level positions?
Yeah, it is. So you're not seeing CEOs with posted wages, for sure. But yeah, it actually is. So here's some examples of ones with uniform wages. So it is, cashiers at Dollar Tree, they're paying $45,000 a year in 35 counties, like Fairfax and Laramie, Wyoming. But there's also lawyers at Target. So lawyers, I don't know if anyone here is lawyers, partners with lawyers. They are classic national wage setters. They also post salaries and ranges. There's like supervisors, financial managers. So you're actually slightly more likely, the online job vacancies tend to skew a slightly higher skill than the average worker in the U.S.
I wonder, do you also have information about the benefits, amenities, or benefits specifically? Is that similar to?
Yeah, we don't think, so we don't have information on that explicitly here, so like the quality of your health insurance. From our conversations with the HR professionals, it seems like this is a much bigger deal internationally. So that benefits vary a ton internationally based on, national health care or things like that, and tax codes and things like that. Whereas within the US, they're much less likely to vary across locations. So I'll show you a little bit. One thing that you might have in mind is something like a bonus. That really isn't playing a role here. People do get bonuses, but they're basically merit-based mostly. They're not kind of like, oh, I gave everyone in San Francisco a bonus because San Francisco's expensive. That's not basically how companies use bonuses. Okay, just to confirm this here, we find something similar in our survey. So we asked respondents if they set the same wages across different locations for the same job for all of their jobs, for some of their jobs, or for none of their jobs. And the majority said they did this for some of their jobs. Almost 30% said they did it for all of their jobs, and only around 25% said that they never do this. Okay, that's consistent with our second fact, which is that it looks like these identical wages are a choice made by firms separately for each occupation. So you see some firms that are setting identical wages everywhere. Some firms pay different wages everywhere. Few firms pay identical wages in some locations and different wages in others. So it's pretty rare to see everyone paying the same wage in most locations, but then they just kind of carve out, a couple cities, right? They tend, if they do it, they do it. But they don't do it for all of their occupations. And so in kind of the law profession, right, lawyers, associates, and partners in many cases have uniform wage setting, but paralegals don't. And so firms seem to be choosing to do it in some occupations and not others. This shows that they're slightly more likely, or medium more likely, to do it for the higher wage occupations. So what this is here is this is the probability that a job has a nationally set wage against the average wage of the occupation. And this is just a bin scatter plot showing you the kind of relationship here. And you can see that these nationally set wages are more likely in the higher wage occupations. This is true even when you throw out jobs that have bonuses and you only look at those jobs that have salaries posted as opposed to wages. Okay, all of this together, another way to think about this is that within firms, nominal wages are kind of less sensitive to local prices. So we're going to look at this by following, and I said at the beginning there was some research that showed that prices were set nationally. So we're going to follow the specification in that paper, which was by Stefano Della Vigna and Matt Jenskow. And we're going to look at this relationship with wages. So here, I'm going to look at a regression between the wage in firm I in region J for occupation O, and I'm going to relate it to the price level in that area, so it's like the price level of San Francisco. And I'm going to include a fixed effect here for the occupation by firm, right? So I'm going to be looking within accountants at Deloitte, right? What is the slope of their wage with respect to the price level of the area in which the job is posted? And I'm going to compare that to a between firm specification that instead replaces this occupation by firm fixed effect. So instead of looking at accountants within Deloitte across locations, I'm just going to have an occupation fixed effect. And what that's going to mean is I'm going to look at the average slope for all accountants across firms, across locations. Okay, so what do I get when I do this? This is this between firm slope. So this is telling me that as prices go up by 10%, posted wages go up by, around 10%, a little more than 10%. So between firms, there's a pretty strong slope of posted wages with respect to the prices. Accountants in San Francisco make more than accountants in Omaha. However, that slope is very attenuated when you look within the firm, right? There still is a slope on average, right? Some firms are doing national wage setting, some firms aren't, but the slope is much, much more shallow. Now, you might think that what's happening is that the firms that are setting you, it seems costly for firms to do, right? To pay your people in San Francisco the same as your people in Houston. So maybe what's happening is these firms that are setting national wages are only operating in places that are similar, right? So that, they're not too far off. And it turns out that's not the case. And so what we've done here is we've restricted ourselves to the firms that are setting national wages. So the slope here is basically 0 by construction. I've selected the sample that aren't changing wages. But what you'll note is they're actually still operating in a similar range of local areas. So it really looks like even though firms are operating in areas that look quite different from each other, they're kind of majority of them, there's kind of a substantial amount of wage compression. Okay, and lastly, I'll go over this quickly in the interest of time, but firms setting these identical wages seem to pay a premium. Okay, so what I'm showing you here is the relative wage premium, so the premium that they're paying relative to the kind of job in other jobs in the area, as a function of the fraction of wage pairs within the firm that are the same. So if you're over here, this means that 80 to 90% of your jobs for cashiers, for example, are all paying the same wage, so 80 to 90% across all your locations. And so what this is saying is relative to firms, if you're in 0 to 10, it means your wages are different in all the locations. Relative to those firms that are very uniform wages are paying like around 20% more than the firms that are kind of tailoring their wages to each occupation, to each location, right? So it's the firms, it's like the best firms, the firms that are kind of at the top of the distribution that seem to be doing this the most. And they're not just paying a premium in Omaha or Houston or whatever, they're actually paying a premium everywhere. So I won't go into the details exactly as how this is constructed, but basically their premium is biggest in the cheapest places. This is the plotting the wage premium by the price level of the area, right? So this is the premium of the national wage setters relative to non-national wage setters in, say, the lowest quintile over here versus kind of the San Franciscos and New Yorks over here. And you can see here the premium's biggest in the cheapest areas. That makes sense. But actually, they're still above the market average in the New Yorks and San Franciscos. Okay, we already touched about this a bit, but we think these facts are not due to the difference between posted and realized wages. In the survey, we found that kind of the decision to post wages and your propensity to do national wage setting are really not correlated. You might be thought that you might want to broadcast hey, if workers like national wage setting, I'm going to highlight that I have this equality constraint, and by posting wages on my job advertisements, that seems to not be the case. I already said that these posted wages tend to track the geographic distribution of actual wages quite closely. And then we can look at similar results in this administrative earnings data. So the numbers here look a little bit different. Why is that? Well, lots of reasons. But a big one is that this is quarterly earnings. And so it has some limitations relative to that. But still you see that the within firm slope is around half the size of the between firm slope. So there seems to be kind of quite a bit of wage compression across locations within the firm. Okay, so I think the descriptive facts show that there's a lot of wage compression within the firm. So why is this? Well, it could be, our benchmark model would say, okay, well this is because the locations are similar. Either their revenue product is the same, maybe they're all selling, maybe maybe that's not that surprising that McKinsey sets national wages, right? Because everyone travels all around. Their marginal product's all the same. They bill at the same rate to their clients. And so maybe it's not surprising that they all have the same wage. And an alternative, which we're going to show some evidence for, is that the alternative is that no, they're actually choosing to set the same wage. We're going to call it, they're constrained to set the same wage everywhere. And now we're going to say they're kind of the national wage setters. And we're going to differentiate between these two possibilities by looking at the changes in wages over time, with the idea being that places may happen to be the same, but if one place gets a shock, right, and you see them passing that through to the other one, well, it's very unlikely that both places got the same shock at the same time. And so we're going to say that it looks like these firms setting identical wages are really doing so because they chose to. So how am I going to do that? So what I'm going to do here is I'm going to look at the kind of co-movement of these wages across space over time. So I'm going to construct all the within firm pairs. So the pair here would be the accountant in Houston and New York, right? And I'm going to look at the change in the wage in the accountant in New York over a year compared to the change in the wage in the accountant in Houston. And I'm going to split it separately by those that initially had the same wage, those national wage setters, and those that initially had different wages. And the idea is going to be to compare this beta 1 coefficient and a beta 2 coefficient. So a high beta 1 coefficient is going to tell me that if you initially had the same wage and one wage went up, the other one went up too. And a low beta 2 coefficient is going to tell me if you initially had separate wages and one went up, the other one didn't really move. Right? They're not looking like they're kind of moving together. Okay, and that's what we're going to find here. So this is sort of our baseline regression. And you can see here that when the wage in one location in your firm goes up by 1%, on average, if you had an initially identical wage, the wages in the other area goes up by like 63%-ish. If you initially had a different wage, the kind of co-movement of your wages, it's much lower. It's not zero, right? Maybe your whole firm got really productive. You rolled out some new technology. Everyone got more productive. Everyone's wages went up, right? It's not zero, but it's substantially lower. And that's basically true, like throwing at this what you will, right? So this one kind of looks within pair of counties. So it says, okay, let me only look at all of the firms that are posting jobs in both Houston and New York. And I'm just going to look at, the relative co-movement for those that are in different firms that are kind of, or initially were equal or not, looks the same. You can throw out tradable industries. You might say, okay, those are setting national prices. Anything that causes prices to move are going to move them for all of my car manufacturing plants, right? And so we're all kind of moving together. Looks the same. You can throw out tradable occupations. You might say, okay, but like accountants, right? You can really like ship your product anywhere. We all know like work from home, things like that. You can maybe they're very national labor market shocks. Okay, sort of looks the same. So this seems to be evidence that kind of the wages that are identical in one period are also moving together a lot over time. We try to do even better here by coming up with a shock to a wage in one location of the firm. So it's pretty hard to come up with a shock that only affects one location in the US. That's very rare. Our best guess at this is what we're going to be calling the natural resources Bartik shock. So, okay, what is that? So this is the idea that through this period, we're going to have basically 2010 to 2019, there were big swings in oil prices, basically driven by the international price of oil. And as you may recall, that created big booms and busts in the natural resources industry, right? So there was a huge surge in labor demand in the natural resource in areas like North Dakota, where there was a lot of natural resources. And so that was a big kind of labor demand shock. But natural resources are very unevenly spread around the United States. So this is a map of the shock, and this is the Bartik shock, which you may have already heard about. But basically the idea is how exposed you were to these big movements in oil prices depends on how much natural resources employment you had, in 2009, so before this period took off. Basically depends on how much, natural resources you have in your state. And so you can see it's very unevenly distributed. Places like Texas basically have a lot. Some of it is over here. The Northeast, Chicago, has none. And so what we're going to be doing is we're going to say, okay, oil prices went up. That created a boom in demand for workers in Houston. We're going to look at what happened in Chicago to the workers that are at a firm that also employed people in Houston, right? And we're going to compare that, so there's to what happened in Chicago at another firm that only had another office in Miami, right? So they weren't exposed through their firm to this big oil boom. But if you worked at a firm that also was employing people in Houston, you were exposed through this national wage setting constraint. So that's the idea. So what do we get when we do this? Okay, so this is the first stage, right? So what would be the first stage of this instrument? It would be what effect does this natural resource, this boom in oil prices, have on the wages of people in the exposed counties, in Houston, in that example, right? And so this says, this kind of confirms the logic of the exercise, which is that when oil prices went up, it bid up the wages of all workers in Houston, not excluding those people who work in the natural resource sector. That's obvious, right? When there's a boom, the wages go up for the people in the sector. But this bid up the wages of people not in the natural resource sector. So the accountants, the people who worked at McDonald's, people came in, more lawyers, more doctors, more, people boom in CVS, whatever. Houston boomed, and that bid up the wages in Houston. This is kind of the reduced form. This is the effect of that increase in oil prices on the workers in Chicago in that example, right? And you can see here that the increase in oil prices led to an increase in the wages of the workers in Chicago only if you were in a firm that was initially paying the same wage, but not in the other firms, right? And so you put this all together, you get basically the pass-through coefficient, that's this IV estimate, is saying, just details of this aside, what this says is that firms that if you initially had the same wage in Chicago and Houston, you pass through the shock in Houston almost 1-for-1 with your workers in Chicago, 0.83 with some standard error, right? And if you initially paid a different wage between Houston and Chicago, you pass through the shock not at all. Why would you? Why would you pay people more in Chicago when there wasn't really a change in demand for workers in Chicago? And so we take this as further evidence towards this kind of national wage setting, that these identical wages are really reflecting some constraint within the firm. Okay, so why would you do this then, right? Why is the firm kind of adopting a constraint? It's not put on them, it's not coming from legislation, right? Why are they choosing to have this constraint? So we ran a survey with HR professionals. Originally, we asked them to, in our kind of pilots, write down kind of free-form answers to why you do this. We coded them up, and in our main survey, we allowed respondents to select up to 3 explanations for why they chose to do this. So here's what they said. The first is that almost 50% said they did this because they were hiring workers on a national labor market. Around 50% said they did this because all of the areas they operated had a similar cost of living. Around 40% said they did this to adhere to internal fairness norms, the idea that it's just right that workers who are doing the same job should be paid the same. Some said they did it because, 35% because it was simple and it was costly to figure things out. 20% said they did that because people moved around their firm a lot and there were frequent internal transfers and they didn't want to have to adjust wages when they transferred people. 20% said they did so because their competitors did. And then the last 10% was other, wasn't very informative. Okay, so what do we make of this? So I think obviously there's no one reason to kind of choose to constrain your wages in this way, but I think several patterns emerge. The first is that one of the reasons firms do it is it simplifies management. They did this explicitly. They told us it simplified management. But I also take this similar cost of living to be reflective of that. Of course, places aren't exactly the same, but close enough. We'll just round. Second, I think that we heard this in conversations as well, that firms do this to adhere to fairness norms that are constraining nominal as opposed to real wages. It's an interesting notion of fairness, right? You might think fairness is we all have the same real wage, right? Why, it seems reasonable that people in San Francisco have to pay more because they have to pay more in rent than I have to pay, right? But this seems to be a fairness that's constraining nominal wages to be the same, right? I'm doing the same job as them. I should be getting the same wage. And then it's kind of this kind of nominal groundings, what the macroeconomists would call this kind of nominal illusion. It's kind of the nominal wage that really sticks in my head when I think of my salary across different places. And then related to that, which is that these national wages seem to be kind of more common for for workers that are really mobile. Again, suggesting that it's the nominal wage comparison that they see when they look across jobs that really matters to workers. I showed you that, firms choose to do this for some of their occupations and maybe not all of them. And I think there are some of these explanations that make a lot of more sense at the firm level, something like it's simple, right? I don't want to invest in kind of figuring it all out. I don't set up my HR strategy that way. So that sort of explains why some firms do it and some don't. And others, I think, make a little more sense at explaining why you would choose it for some occupations, not others. And those are things like, mobile workers, kind of national labor markets. And then, while these respondents mention lots of things, I think some explanations are notably absent. And so people don't mention the minimum wage. They don't mention unions, policies that you think, might constrain wages to be the same across locations. Okay. And then lastly, we want to think about kind of what are the consequences of this. We'll start with what are the consequences for the firms who are choosing to set this national wage, right? Is there money at stake here, or is it kind of like, close enough? And hard to know, but we'll just do a back of the envelope here. We'll try to say how much is at stake from national wage setting? How much are you leaving on the table by setting the same wage versus kind of tinkering and tailoring your wage to all locations? Now, it's not necessarily how much are you leaving on the table. If you talk to firms that do this, maybe some of you have worked at them, they think this is productivity enhancing. They think workers like it, and that it kind of boosts morale in their company, and it increases productivity. So this would say, how much of an increase in productivity do you have to think it produces in order to kind of make it worthwhile? And the way that we're going to do this is we're going to use the difference within firm difference between two locations for the non-national wage setters to give us an estimate of what the difference in wage would have been had they not set the national wage. So let me be concrete here. Let's go back to my Deloitte and McKinsey example, right? McKinsey, they're a national wage setter. They're the same wage in Boston and New York. We say, we want to know what was the difference in wages between Boston and New York that McKinsey would have said if they hadn't had this policy. So for that, we're going to look at Deloitte. Deloitte might be a national wage setter, I don't know. But I'm going to pretend for this example they're not. And so I'm going to say, okay, what is the difference in wages between New York and Boston that Deloitte is doing? Say New York and Deloitte have a difference in their wage of 7%. I'm going to say in the absence of national wage setting, McKinsey would have varied the wages by 7%. And so when I do this for all of the pairs of locations for national wage setters, I see that the median gap in wages is around 6%. So the wages are actually identical, but the median would have been kind of off by around 6%. And so we can then just use kind of some structure of a basic economic model to say, there's some profit maximizing wage, right? When you set a wage that's not profit maximizing, there's some loss from that. And we just, have to make some assumptions about parameters of the model to say how big is that loss. So when I misprice something by a little bit, there's some effect on my profits. The structure of the model will tell me what that is. And when I do that, you have to make some assumptions, but you see that the median profit is around, something like 4%, 3.5%. And so, is that big? Is that small? It's an eye of the beholder. But I think it suggests that, they're doing this even in places where there's, a decent amount of money at stake. All right, I'll leave it there. Let me just conclude here. We document that there's a substantial amount of wage compression across locations within the firm. We think that the kind of pass-through results suggest that this compression is really reflecting national wage setting, so a choice made by these firms. And, future work can kind of think about the consequences of this for things like worker welfare, for things like income inequality, for things like monopsony power. These firms are really big, right? You think they're really big locally, but if they're setting wages nationally, maybe they're not kind of using their wage setting power they might have. And it has implications for things like nominal wage rigidities for kind of macroeconomists to think about, which is that, if I'm setting these national wages, I'm actually not responding very much to kind of local shocks that may be happening. And that has implications for monetary policy and what have you.